Folks, it's close to St. Valentine's Day, a day of love and relationships where many of us celebrate by buying gifts for the people closest to us. If you're like me, though, you probably sometimes wonder about the point of spending money on gifts that don't appreciate and value once given. If this is you, then we have some ideas for stock gifts that are currently trading either cheap or cheaper than usual, making them a gift that could add a bit of green to both your day and your portfolio. Dave Sequeira is the Chief U.S. Market Strategist for Morningstar Inc., and he's here today to tell us the 5 stocks he loves. Dave, thank you so much for being here today.
Hi, Ruth. Good to see you.
So let's talk about the first stock, which is the maker of chocolate kisses, the Hershey's Company. It's currently trading at 3 stars. Tell us a little bit about this stock.
Well, what is Valentine's Day without chocolate? As you mentioned, Hershey stock is a 3-star rated stock. It trades pretty close to our fair value. But I do think this is a good opportunity to be able to buy a high-quality, low-volatility company at what we consider to be a reasonable valuation. In fact, when I look at the stock chart over the past 5 years, the stock has actually traded pretty far above its fair value for quite a while. In fact, I think it was even a 1-star stock in early 2023. Since then, it has sold off. It's down about 30% from its peak and is back to that 3-star level. Now, from a fundamental point of view, we do rate Hershey with a wide economic moat. That's based on a combination of 2 things. First, it's intangible assets. So the company does have a 45% market share in chocolate in the U.S. And in fact, I think its next closest competitor is only 30%. And we also think it has a cost advantage based on its scale that allows for low unit costs as well as low distribution costs, as well as some greater supply chain efficiency. Lastly, we do rate the company with a low uncertainty rating. It does have a very healthy balance sheet. And just to follow things up, the stock does pay a 2.5% dividend yield. Not exactly a real high dividend paying stock, but still about twice the average of the S&P 500 right now.
Another stock that makes the cut is Tapestry, which owns brands like Jimmy Choo, Coach, and Kate Spade. Now, I would like a Kate Spade bag for Valentine's Day, but this stock is cheap. Do you think that might be a better bet?
I'm not sure if it'll be a better bet for you or not, but the stock is undervalued. It's a 4-star rated stock. Trades around a 30% discount to our fair value, and I think it currently yields about 3.4%. It's also a company we do rate with a narrow economic moat. Now, I would note this one is a little bit of a story stock. So last fall, Tapestry announced as acquiring Capri, one of its competitors, and the market did not like the deal at that point in time. However, our equity analyst team actually sees the deal favorably. A couple of the different attributes they like is the way that it combines, some of the different brands in the handbag sector. So it does put together Coach, Kate Spade, and Michael Kors. And among its other luxury segments, our team also noted they think that Tapestry management might be able to better grow the Versace and the Jimmy Choo brands better than Capri management had. I'd note the stock has traded up after its recent earnings announcement. So we still think there's further for this stock to run from here. However, I will note that this isn't necessarily an overnight story. I do think it may take at least several quarters after the merger before we really start to see some meaningful results from that acquisition.
Another popular Valentine's Day gift is cosmetics, and a beauty company actually makes the cut of your list. Tell us a little more about that one.
Yeah, so it's Estee Lauder, and that's, the company is a global leader in the prestige beauty market. Includes products such as skincare, makeup, fragrance, and so forth. The stock now actually soared in 2020 and 2021, but we thought it just got, too far ahead of itself back then. In fact, that stock did reach, 1-star rating. It has since sold off, pretty dramatically since then. In fact, it's really round-tripped all the way back towards, pre-pandemic levels. Now, I will note results have been under pressure for, a couple of different quarters. Mostly it's really just from the softer economy and weak consumer spending, especially in its Chinese markets, and that has pressured its top line and compressed operating margins. Now, looking forward, we do forecast that company will generate 7% sales growth over the next decade, and we look at that company as being able to generate a 16.2% operating margin. Now, this stock also had a nice pop after earnings, but it still remains significantly undervalued. Now, it also may be, in my view, an interesting play on when Chinese consumer starts to recover. And then lastly, I would note it's a 4-star rated stock, trades also at about a 30% discount to fair value, company we rate with a wide economic moat, currently has a medium uncertainty and a 1.8% dividend yield.
If you're a type of person who actually prefers experiences over stuff, there's a stock for you as well. Dave likes Carnival Cruise Lines, which is a perfect gift for a romantic getaway. Dave, tell us a little bit about this stock.
Sure. So Carnival is the world's largest cruise line company. And I would note here that the stock had really just plunged with the emergence of the pandemic. And I'd note it's actually failed to meaningfully recover since then, which is why we think the stock is so undervalued today. It's a 4-star rated stock, trades at about a 40% discount to our fair value, although I'd note it does not pay a dividend. So if you're a dividend investor, this may not necessarily be for you. It's a company we rate with a narrow economic moat. And I'd also note it does have a high uncertainty rating. So again, maybe better for investors that can take that high uncertainty in their portfolio. Now, looking forward, we do think the cruise industry is improving. Bookings, have substantially recovered. And when we look at pricing, we're expecting pricing to increase up to enough in 2024 that it actually will be ahead of pricing back in 2019. Now, there have been some inflationary headwinds like fuel costs having gone up, but we also do think that higher occupancy levels will offset some of those higher costs. In fact, some of the things the company is doing is that they're scrapping some of their older underperforming ships. And as such, we expect margins should improve over time. In fact, our team is forecasting their EBITDA margin to expand to 29% from their historical average of 27%.
The final stock on your list is slightly unusual, but actually deals with matters of the heart. It's medical device manufacturer Medtronic. Whether you're heartbroken or not, eventually all of us might need some amount of cardiac care, which is probably why you like this stock, Dave. Is that right?
That is. So the stock is currently rated 4 stars. I think it trades a little bit over a 20% discount to our fair value, and the company's stock yields about 3.2%. A high-quality company, one that we rate with a wide economic moat. We also assign a medium uncertainty to the stock here. And I just note Medtronic is one of the largest medical device companies in the world. It makes medical devices for chronic diseases, and their products include pacemakers, defibrillators, heart valves, and stents. And this is also one that, according to our healthcare team, they think Medtronic is one of the best positioned med tech companies for the continued aging of the baby boomer generation.
Great. Thank you so much for joining us today with your perspectives, Dave.
Of course, always happy to speak with you, Ruth.
For Morningstar, I'm Ruth Saldana.